investors will get a chance to see whether the global COVID-19 recovery is spluttering to a halt with this week's economic calendar. The US markets are in a weird place at the moment, with the Dow Jones repeatedly hitting its head on 28,000, lacking the gumption to rebound above that level. Now it appears that COVID-19 fears have returned to the forefront, with investors scared by the fresh case numbers coming out of Europe and the likelihood of a wave of new lockdowns across the continent. And that's not to mention that US deaths are now above 200,000, with the country seeing daily case numbers that are regularly nearing the 50,000 mark. The focus of the week's economic calendar is Wednesday's flash manufacturing and services PMIs, which now arguably carry even more weight given the worker-seeing coronavirus situation. Investors are going to be after signs that the economy is still bouncing back rather than a short-term summer boost that has stalled out after an initial wave of reopenings. For August, the former rose from 51.3 in July to 53.6 before being revised lower to 53.1, maintaining growth after the contractions in April, May and June. This time out, the manufacturing PMI was expected to go in reverse, with analysts estimating a 52.5 reading. As for the market services reading, at last count, that stood at a more robust 55.0, revised higher from the initial estimate of 54.8, and a huge increase on July's still shrinking 49.6. Like with manufacturing, analysts are expecting a slight retreat with a forecast of 54.5. Before that, Fed Chair Jerome Powell makes an appearance on Tuesday, fresh off disappointing the markets with last week's FOMC statement. Though, to be fair to Jay, he did pretty much exactly what was expected. Investors just seem desperate for something fresh in regards to stimulus at the moment. Thursday then sees the latest jobless claims figure, chasing a fourth consecutive sub-900k reading before the standard and core durable goods orders numbers on Friday. Of course, there are also the intangibles, like the market's feelings towards the tech sector, which doesn't fully recover after its blockbuster summer came crashing to a halt in early September. More than any of these things, what would really move the markets is a bipartisan COVID-19 spending plan from Congress, something that the Fed has been insisted is needed for months now. Every day that the Republicans and Democrats fail to agree on a new fiscal stimulus plan, the US economy recovery is further endangered. Yet with the election drawing closer and closer, a vote that now somehow got even more heated with the death of Ruth Bader Ginsburg, it's perhaps hard to see a deal getting over the line. It's going to be really interesting to see how affected the US markets are by what seems to be at the moment Europe-focused upswing in sort of coronavirus fears. At the moment, it does seem to be the attention seems to be paid on perhaps lockdowns in France and the UK in particular, whereas there hasn't really been much talk of a nationwide lockdown in the US, especially given that really even back in March, the United States was sort of functioning on a state-by-state basis, given how, in terms of the severity of each individual lockdown. I think in the US, the focus is increasingly going to be on the election and what that means for any spending plan going forwards. Whereas I think in Europe, the focus is firmly on the actual practicalities and costs of a second lockdown. And it'll be interesting to see how much that carries over to the US, which does tend to lead the European indices more so than be led by the European markets when it comes to trading.